The McIlvaney Weekly Commentary, covering monetary, economic, and geopolitical news events. Now here are Kevin Orrick and David McIlvaney.
Welcome to the McIlvaney Weekly Commentary. I'm Kevin Orrick along with David McIlvaney. David, today, of course, Ambrose Evans-Pritchard is going to be on the line. And the reasoning behind that, bring to me what the reasoning was as to why we would want to talk to Ambrose at this time.
You know, as we look at the global economy, we look at U.S. growth trends, we look at European trends and things that are either accelerating or decelerating in terms of a point of crisis in the Eurozone. As we look at China and their lowered estimates of growth, Kevin, it's important that we continually look for various viewpoints, some that we agree with, some that we don't, but in order to gain the right perspective on what is actually happening, there's not only a huge amount of information, but there's a need to sort through that information, sort it effectively, and create a synthesis, if you will, of what is actually happening. So our attempt to do that with various guests, and certainly Ambrose today, is to look at oil, to look at global currencies, to look at global equity markets, to look at the global economy, and try to get a snapshot of, from his perspective there in Great Britain, what exactly is happening today.
Well, and I'll tell you, David, when we get to the end of each year, we were talking about this, Ambrose is almost always one of the clips that we like to play when we do the best of shows, because we go back and we look at it and we say, okay, who brought something to the conversation that was new? And Ambrose has been reporting internationally for 30 years. He works for the Telegraph, but really, that's probably putting him in too small a box, isn't it?
Kevin, the frustration over the years has been whenever I'm in Europe, he's someplace else, whether it's China or wherever else. And, just here in the next week, I'll be in London, but he's not going to be there. He'll be in Germany. And actually, I'll be in Germany as well, but it'll be 2 days after he's in Germany. So we, at some point, will sit and either have a cup of tea or a good pint and be able to have a good conversation across the table instead of across the pond and via the long-distance phone lines.
One of these days, we'll just have to nail one of you guys' foot to the ground so you can spend a little personal time together other than just on the phone.
That'd be great. Well, until then, Ambrose, thank you for joining us again. Aristotle said that youth is easily deceived because it's quick to hope, and it appears that the equity markets today are full of hope. We've got liquidity-induced rally largely built on that one factor, hope. We wonder what else are the markets rising on the basis of, and we'll get to that in a moment. And before we do, some of the headwinds to recovery seem to be in the oil market. We've got Brent above 120. We've got West Texas Intermediate above 105. Is this a factor that you think could derail a recovery either domestically in the U.S. or a global recovery?
Well, the head of the IMF, Christine Lagarde, has been warning repeatedly over recent days that an oil spike could basically abort the global recovery before we've got a fresh cycle of growth safely underway. It's now emerged as a new threat after the European sovereign debt crisis has sort of gone into abeyance for a while, into remission, I would say, because it hasn't gone away. But we're at a level where energy costs are nearing 9% of global GDP. And typically that's been the trigger point for recessions, global recessions over the last 40 years. It's not inevitable, and it depends how long prices stay there, if it's just a few days or something. But if they go much higher than this and they stay there for a couple of months, that's going to cause serious damage, I think.
Well, so what sort of range is oil likely to trade in, on the high side or low side? We've got demand destruction as we see GDP growth estimates both in Europe, China, Australia, in decline. In the U.S., I suppose we've got GDP growth estimates on the increase, so one positive in the mix. But this would argue globally for demand destruction and maybe lower prices.
Well, what's so strange about this is that you've got essentially quite a sharp global slowdown right now. You've got Europe in recession and likely to contract for the whole of 2012. You've got China paring back its growth estimates all the time. I mean, whether it's a soft landing or something a bit harder, it's clearly something of, it's harder than people expected a few months ago. And yet, even so, you've got quite marked slowdowns in India, and Brazil and other countries. And even so, you've got Brent trading up near record prices, certainly in European currencies, around $125 a barrel.
Which raises the question of the Middle East tensions and...
Well, exactly. I mean, what this tells me is a fundamental structural shortage of oil in the world, that even when you've got a major global slowdown, which normally should eat into demand and bring prices, clattering back down into sort of, $60, $70 a barrel, it hasn't done so this time. They're still at or near record highs. It's a warning. Well, what happens as soon as demand picks up again? We're going to run straight into the constraint. And on top of that, we got the wild card of a Middle East, a potential Middle East conflict. I'm not in the camp that thinks Iran's going to close the Strait of Hormuz. Either they would try, or if it did so, whether it could succeed for very long. If there was a Western strike against Iran, it would have huge political ramifications and potentially destabilize the region in ways that can't be predicted, and set off inter-ethnic conflicts and sort of Shia uprisings, potentially in Saudi Arabia and Bahrain and places. It's really a pretty unstable situation. A lot of unpredictable things could happen. And I think that's the risk. And certainly there's a bit of that premium in the market price for oil right now, but the real cause is fundamental. You've got eroding oil fields in the North Sea, in the Gulf of Mexico. You've got endless disappointments in global oil supply around the world. It keeps falling short of what was promised, and they're having trouble finding new reserves that are economically viable to tap. That's the fundamental problem.
Just coming back to that idea of ethnic conflict, Shia uprising, this might be one war too many. We've already seen the Russians and the Chinese line up against a Western strike, and it seems that might in fact be a trigger for them to say, thanks but no thanks. Our protest will be an economic protest. Our contribution to the new and fresh Iranian conflict will be via the currencies. We don't need the dollar, and we don't need the dollar system. We're sorting out ourselves in other ways.
Yeah, I mean, it's very hard to read diplomatically what China and Russia are doing here. I mean, essentially, I don't think China wants to rock the boat. They're sort of looking for a kind of a way of navigating through this and keeping their head below radar, essentially. I don't think they're about to sort of launch some kind of punitive strike on the United States in retaliation through the currency markets. I think what will happen is that the Chinese currency will, over the next 3 or 4 or 5 years, become a global currency. It'll be liberalized, it'll start trading through Hong Kong, and then it'll quite quickly achieve full status as a global reserve currency. Let me point out, the reason why China owns $3.2 trillion of reserves, by far the biggest in the world, and the reason why it holds about $1.8 trillion of U.S. debt, is not because it's doing a favor to the United States. It's been doing that in order to hold down its currency. Mm-hmm. That is the automatic effect of its mercantilist currency manipulation of holding down the yuan to gain export share. So if it ever launched an attack on the dollar or ever pulled its investments out of the United States, it would automatically see its own currency shoot up and would put a lot of its exporters out of business. So this is simply the flip side of its whole export trade mercantilist policy. It accumulates reserves, it buys U.S. bonds, that it has to do so. And as soon as it stops buying those bonds, its currency will shoot up. So they'll shoot themselves in the foot, is my view.
Yeah, on that we would agree, because it's the TIC flows and the gradual reduction of Treasury exposure that everyone assumes on sort of a slippery slope basis will become a flood out of Treasuries. And we would say, no, in fact, that would be them hanging themselves with the noose of their own creation. In fact, they've bought the Treasuries for political purposes to maintain a high level of employment and continue export growth. And they're having a very hard time, transitioning from being an export-centric economy to being an internally generative economy.
Yeah, it's an interesting point that they've accumulated in reserves equivalent to 6% of global GDP. And to my knowledge, they're only in modern history when this has occurred. And one was in Japan in the 1980s, which of course ended very badly for Japan. And the other was in the United States in the 1920s, which ended very badly for the United States. Both episodes were succeeded by depressions. There's a connection between them. Accumulating vast reserves in this fashion is not a sign of a healthy economy. It's a sign of a completely distorted economy that's relying on an undervalued currency to gain global market share, as soon as somebody else yanks away the rug and the game ends, you're in trouble. And I think that's the risk that China's in, that faces, that potentially the global trading system, the open global trading system, as we've known it for the last sort of generation, 2 generations, starts to close. And then if you're the great surplus power, you're the one in trouble. All the deficit countries can start using protectionism to revive their own industries, but you're the surplus power and you're entirely reliant on your global markets. Then you're in trouble. This is something that's occurred over the last 200 years a few times. And so I don't see this huge imbalance in the world as particularly an advantage to China. I think it's got all kinds of risks for China itself.
Now, it seems there's some peripheral risks to it. You see slowing GDP growth in China to 7.5%, with a gradual drift by many economists' estimates to 3 to 4%. And as you said, massive loan growth in recent years, surpassing the record numbers relative to GDP set by Japan in their bubble years. It's not a stretch to see a similar outcome. But at the periphery, you've got Australia, you've got Brazil, you've got their primary commodity trade partners, which are vulnerable to a slowdown in demand for that product, not only as they export, but as they are growing their own domestic infrastructure.
Yeah, I mean, you've had the Australian mining group BHP Billiton warning today that China's steel demand is essentially plateaued. It's just tailing off now. I mean, this is a fundamental change for the iron ore producers of Australia and Brazil. And I'm not sure, there are two issues here. I mean, what does a sort of soft to hardish landing in China do to China, but also what does it do to the rest of the world? The Chinese stock market has already discounted a major adjustment in China, if you like. It's already fallen about 63% from its peak 4 years ago. And in real terms, by the way, it's fallen almost as much as the Wall Street fell in the early 1930s, peak to trough. It was because America was deflating in the 30s and China's been having inflation. If you look at it in real terms, the stock market collapse in China has been almost equal to the United States between 1929 and 1933. And that's a fascinating fact that very few people are aware of. That's already anticipating some problems in China. The insiders in China know there's a lot of problems coming up. But commodity producers around the world, the commodity countries like Australia, Chile, other countries, they have not adjusted in the same way at all. And yet their economies are essentially levered and trading off supplying the voracious, industrialization demand of East Asia. So there's something wrong here, something's out of alignment. Either the Chinese stock markets are right or the Australian, Chilean, etc. stock markets are right, but they can't both be right. One of them is wrong.
And it seems that it is a difference of opinion in terms of a return to the growth trajectory that we had prior to 2007, 2008, or in fact a slower period of growth and in fact a decline for the foreseeable future, which would be heralded by the Chinese equity markets. Well, you've spent a lot of time in the European space. I'm very interested in your opinion. You said again that this may cycle back around. Are we post-crisis, or is what we see today really a delay on the basis of these LTRO maturity schedules? We've bought 3 years. Is that the time frame we have, or the fuse that burns, so to say?
Yeah, I mean, in terms of the global picture, I think the stock markets and risk markets around the world, they're basically assuming, that three things have happened. That, China's basically touched down, had a soft landing over the winter, is now beginning to recover. The ECB's, the Draghi bazooka in Europe has basically saved the European banking system, conquered the debt crisis, sovereign debt crisis, and basically, it's all back to the races. And that America's finally got out of its troubles, and the subprime crisis is over, the property market stabilized, and we're back to a new cycle of global growth. I mean, that's essentially what a large part of the markets are sort of essentially saying. And a lot of the analysts, the reports you get out of, this is a theme that they're all pushing on. Now, in terms of the European bit of it, what Draghi did was very important, because in October, November, the European banking system was going into meltdown, especially in Spain and Italy, and it was extending to France. We had a calamitous slide underway. If they hadn't done anything, I think you would have had a series of major sovereign defaults, a completely calamitous chain of events, and who knows what would have happened. And you can argue it would have cleared the air. You would have taken your punishment early, painfully and quickly, and got over it. Instead, it drags on. But anyway, I mean, he intervened. It was incredibly important. It's taken away the tail risk of a collapse of the European banking system. That is no longer going to happen. But they have not solved a fundamental problem here, which is Northern Europe and Southern Europe cannot share a currency union. Southern Europe is probably 30% overvalued against Northern Europe. How this has come about is a long story, but it's essentially we're now where we are, and the South having to claw back competitiveness by deflating the old-fashioned way, what's called an internal devaluation. They can't devalue their currencies anymore, so they're having to do it internally by cutting wages and going through deflation. The laboratory for this was Greece, and we saw what happened. The more they cut, the more the economy contracted. They went spiraling downwards. The Bank of Greece announced today that the deficit is still over 10% of GDP. They're in their fifth year of recession. The economy contracted 6.9% last year, and the budget deficit hardly came down at all. And there was all these cuts, these massive cuts, have simply tipped the economy in such a vicious downward spiral. They're not even getting a reduction in the budget deficit. It's just simply destroying the tax base. And so it's become self-defeating. And that is essentially the model that's now been imposed on Portugal. Portugal is about 15 months behind Greece, but it's pursuing very much the same policies. It's got the same fundamental lack of competitiveness, the same sort of trade deficit, current account deficit, equally overvalued as Greece. It's less well-educated than Greece. And it's got a much bigger aggregate debt than Greece. Its combined public and private debt is 100% of GDP more than Greece's. Greece is actually one of the lowest debts in Europe as a percentage share of GDP. It's only 250%. Britain's higher, the Netherlands are higher, Denmark's higher, Spain's higher, Italy's higher. Greece is actually one of the lowest. This isn't actually a debt crisis at root. That the debt problem has surfaced because these countries can't compete. That's the problem, and that problem has not been addressed. And essentially, they're trying to sort of paper it over because nobody will bite the bullet and recognize that the whole venture of currency union, the whole venture of the euro, is a failure. It's created huge structural problems. It's acting now as the gold standard did in its deformed structure in the early 1930s, when it was causing all the weaker states with deficits just to carry all the burden of adjustment and tighten their belt and tighten their belt and tighten their belt until it eventually took the whole system down. And we're sort of going through this stage by stage. And you can almost go back to look at the years from 29 to 35 to 36 and then transpose this onto Europe and see what they're doing now. And we're probably in around 1933, 1934 now, and finally the whole thing blew apart in 1936. We're going through this stage by stage, and they're repeating exactly the same policies. It's essentially a fixed exchange rate system that's got a deflationary, contractionary bias in it. And the weaker countries are the ones that get hit first until they sort of ground into the dust. And unfortunately, while in the case of Greece, it's taken we've had a debt haircut. The creditors have lost 3/4 of their money. That set a terrible precedent, by the way, because the markets and investors essentially don't believe Greece is a special case. They think this is going to be transferred to Portugal quite soon. And ultimately, then you've got Spain and Italy. They're further off. It's not as acute. It's a sort of slow grind. But we're seeing in Spain that youth unemployment is already 51.2% in Spain already now. And they're only now embarking on a quite draconian fiscal squeeze this year.
Just a reminder, you're listening to the McAlvany Weekly Commentary at McAlvany.com, McAlvany.com.
Well, a couple of things. I started with a quote by Aristotle, youth is easily deceived because it's quick to hope. It's also quick to anger. And I wonder if there isn't a political fuse of some sort that's lit in these southern European states. Is the fuse out in Greece? Are we not only out of the limelight, but out of the point of political strain in that country, and thus have more to focus on with Portugal and Spain and Italy? Or are you arguing that actually you can see all of these still engulfed flames, so to say, of a political nature?
Well, I certainly think that we moved from a phase where it's moving from being a purely financial crisis to being a social and political crisis. And the politics will determine the outcome. Now, in the case of Greece, because they're sort of cut off adrift in the edges of Europe, really in the edge of the Balkans, right next to their historical nemesis, Turkey, for them, it's an existential issue. They'll go through anything to try and remain part of Europe. So their willingness to sort of to tolerate a lot of these sacrifices and do whatever they think it takes for Europe is perhaps greater than for some countries. Because for them, it's just their cultural lifeline, their sense of identity as being Europeans would be at risk, if they got thrown out of the euro. and they're also quite a small country, it's only 10 or 11 million. When you start getting to a country like Spain, you're in a whole different game there, because this is a country of 48 million with a very, very proud country. It's not as isolated. It won't let itself be pushed around by Brussels and the EU system in quite the same way. We've already seen a showdown. The new government came in pledging to do austerity, a really quite nasty fiscal squeeze this year, and then looked at the books. They discovered that it was far worse than they had feared. They were advised by their top economists that if they carried out the cuts demanded by Brussels, that unemployment would reach 6 million by the end of the year in Spain, which for a country of 48 million is an awful lot of people. You'd be getting up to 25-26% unemployment levels by the end of the year if you did that. And they said, no, we're not going to do this. They simply, to my knowledge, no country's really done in the time, all the years I've been covering European affairs on and off, 20 years or more, I've never seen this happen before. They simply, absolutely said, we refuse point blank to obey the EU budget rules. We're not going to do it. It's suicidal. So this is the beginning of what I think is a mutiny in the South, of what I call the Latin bloc. And I think we're seeing it in different forms developing in different countries. We're seeing the new Prime Minister in Italy, who's actually a former EU insider. He was 10 years, he was a commissioner in Brussels himself. He's now beginning to kind of lead a Latin bloc that's saying, right, well, why should we put up with destructive policies being enforced upon us? And starting to sort of say, right, okay, if we form a united front, we can change the whole terms of debate. We can stand up to Germany. And so we've had this kind of new dynamic developing in Europe where these countries, big countries, Italy, Spain, and all the small countries coming around, with them, are standing up to Germany and saying, no, we don't agree with you. At the moment, it's still polite, but the beginnings here are a major, major clash between the north and the south of Europe. Don't know how this is going to play out. We've got French elections coming in May. The socialist candidate is likely to win, François Hollande, and he's likely to sort of throw his weight behind this Latin camp that want a complete change in policy, which is to move from an austerity policy towards a growth policy, essentially. When that moment happens, it's going to cause a huge conflict with Germany. And, then the issue is, well, who leaves the Eurozone first? Do the Germans simply say, we're not going to put up with this any longer. We totally disagree with the way this is going, and say we're going to leave. Or do the southern states get pushed out? I mean, I think it's a toss-up, actually. I think it's incompatible. I think this has to break up. How it breaks up, whether the north leaves or the south leaves, or there are all kinds of ways it could happen, is not yet clear.
Well, shifting again back to the global economy, we've got slowing growth, and that's likely to be a continued theme through the second half of the year. Would you pick a point on the calendar where you'd say we've likely seen a peak? How would you gauge sort of the trajectory coming into the end of the year?
This is the huge question that everybody's asking themselves. I mean, there are a lot of skeptics out there, a lot of very sophisticated economists and analysts and who just don't quite believe this recovery is real. They don't believe that there's a new cycle of global growth underway that's going to last several years. The great deleveraging hangover from the bubble is not yet over. But exactly what's going to cause it to tip over, I don't know. What I think will happen, I look at the money supply closely. I notice that the real M1 for the biggest 14 economies in the world, well, the biggest 7 developing and the biggest 7 emerging market economies, has begun to tip over. It's peaked in November, and then it's been contracting every month since. The rate of growth has been slowing quite sharply ever since, and that's been a very good leading indicator. And so it came right down. It really slowed quite dramatically by February. Now, that tends to give you about a 6-month lead time. That would tell you that the global expansion is going to roll over in the early summer. And the second half is going to be a lot, starker, really. Markets tend to anticipate this sort of thing. They tend to sniff it out before it happens. So you'd be talking about maybe the markets peaking in late April, early May, and rolling over. I just add also that, I think in terms of America specifically, we have had a major money supply growth, but it's actually stabilized over the last 2 months. And I think, Bernanke warned about this in his Humphrey Hawkins' testimony. The U.S. faces what he called a massive fiscal cliff at the end of the year when all these automatic tax rises come in force unless Congress decides to do something to prevent that happening. The payroll tax holiday, the Bush tax cuts, and you've got all these, I think it's Medicare taxes, but there's a whole range of them, all going to basically hit at once. And he was warning this is going to be quite a shock to the system. Well, I also think the markets are going to start thinking about this as this approaches. They're not going to wait for it to happen. So as we get beyond, we'll probably going to be one of these cases where it's, sell in May, come back on Labor Day, whatever it is. Suddenly in the summer, everybody says, my God, we got overexcited about all this. We thought everything we were back to the races, and it's not. We suddenly got all these other problems reemerging. We've got the delayed effect from the oil price being at $125 a barrel, which, as we saw last year when we had this, in the Arab Spring, when this occurred, oil prices were kind of this level at that time, a year ago. But it wasn't until June, July, August that people really began to feel the full consequences of the global slowdown.
So there's a couple of dynamics here. You've got that sell in May and go away thematic. You've got, what we would have considered sort of beware of the Ides of March, maybe it being sooner than May on the basis of the S&P trading up 20% off its lows in October and now 2 standard deviations above its 50-day moving average. These are incredibly high, overextended levels, but it is not turning down. And the question is, are we, again, coming back to that keyword hope, are we hoping that a central bank, undisclosed, but a central bank somewhere in the world is going to juice the system? The Fed has been on hold. The ECB took their turn in the late months of last year through the refinance operation, the quote-unquote LTRO. Is it the People's Bank of China? What is likely, in your opinion, to keep things elevated to May, other than hope or some promise of new monetary stimulus?
Well, there is a lot of confidence as a return, and that has its own
energy.
That has its own effect. And you must remember that U.S. corporations alone are sitting on $1.2 trillion in cash reserves. It's a heck of a lot of money, and they're sort of been waiting for sort of signs of optimism to sort of start throwing that back into battle, so to speak. And some of that's going to happen. It maybe is happening right now. I think there's still essentially what used to be called as the Greenspan put, the assumption that central banks will come in and save the day if necessary. That's still there. People think, well, if things get tricky and we misjudge this, the ECB and the Fed and Bank of England will step in again and just throw more money at it. I think right now that's not going to happen. I think the threshold's quite high, both at the Fed and the ECB. I think they've begun to talk about inflation again at the Fed.
Well, that's why we started with oil and why it's such an important component, because on the one hand, they may want to continue the growth trajectory and these quote-unquote green shoots, the conversation piece from 2 years ago. But the consequence of any stimulus at this point, with Brent at 120 and higher, West Texas at 105 and higher, is that any attempt to juice the economy is really derailing the recovery, as energy costs, as you well pointed out, are already above 9% of global GDP. So the minute they step on the pedal, so to say, is the minute they throw us right into recession, classically triggered by these energy costs. So it really on the horns of a dilemma. I frankly would hate to be a central banker today for many reasons, but least of which you don't have very good options.
Yeah, that's right. They can't. They would have to wait, I think, for very, very clear signs of a sort of slowdown emerging before they act again. I think the political resistance in Europe to any more stimulus from the ECB is pretty big. And you had the head of the German Bundesbank and the former chief economist of the ECB, who's German, coming out publicly just slamming the ECB for behaving irresponsibly and just throwing liquidity all over the place and storing up all kinds of problems of moral hazard and future inflationary risk and so forth. Basically, they're speaking for the German nation, and when the German nation says we think the ECB is behaving irresponsibly, my goodness, it makes it extremely difficult for an Italian president of the ECB to continue doing this. Essentially, the political constraint on him is enormous. So I think that basically card is played. I don't think they can do any more of these LTROs. And furthermore, I think by doing them, they prevented themselves from doing QE. QE would have been more effective, in fact.
Well, Ambrose, just as we wrap up, I'm curious if you would venture an opinion on the two greatest areas of market risk today. In the bond market, in the equities market, in the commodities space, if you had to pick two areas where you thought, that's really an area, the pea patch that you don't want to necessarily walk through, be very, very cautious, what would your instincts tell you?
This is a really difficult moment. As they say, I don't have a firm conviction on that. I'm just watching and waiting. I suspect that treasuries and government bonds are going to sell off quite a bit. There's going to be a nasty little bear market, but it'll go too far, and then bonds are going to rally yet again. Treasuries are going to rally yet again. When people realize that this fundamental crisis in the world is not over, I think they come down again to below 2%, and it's actually stocks that would become more vulnerable. For the next few weeks, I don't see that as a problem. Maybe we could have a phase where stocks go shooting on up, there's a massive sell-off in bonds, everybody's buying into the recovery story until suddenly a series of things happen. Fundamental economic events and data basically cast a pall over this. They realize that the problems aren't solved. And at that point, I think we have, one more big rally of U.S. treasuries and bunds and gilts in Britain. And, that's not played out yet.
Well, perhaps we should abide by the old trader's wisdom of sell in May and go away. Ambrose, thanks so much for joining us, and we look forward to seeing you at some point on the other side of the pond.
Jolly good. Thanks. Bye.
Well, you've been listening to the McIlvaney Weekly Commentary. I'm Kevin Orrick along with David McIlvaney and our guest today, Ambrose Evans-Pritchard. You can find us at McIlvaney.com. That's McAlvany.com. Or give us a call at 800-525-9556.
This has been the McIlvaney Weekly Commentary. The views expressed should not be considered to be a solicitation or a recommendation for your investment portfolio. You should consult a professional financial advisor to assess your suitability for risk and investment. Join us again next week for a new edition of the McIlvaney Weekly Commentary.